What's up, apes? Welcome back to another edition of the 𝗙𝗟𝗡𝗚𝗏 podcast / video stream of the day. My name is David. Thank you all for joining us once again on another edition of the podcast here. Guys, by the way, make sure if you love WSO's content, a great way to give back is just simply by liking, subscribing, giving a thumbs up, leaving a rating, talking about how dope it is, a 5-star rating, whatever you want to do to just help boost our algorithm a little bit. We would absolutely love the support out there. We love all of you guys who come back and watch or listen to us on a regular basis. I don't know how you can stand listening to my voice on a regular basis with that regard, but nonetheless, if you want to give back to WSO and help us out at all, make sure to boost our algorithm. We would love you for it, and I'll send you a free kiss in the mail if you do so as well. With that said, I'll stop before the sexual harassment claims start rolling in. Let's go ahead and get into the stuff that everybody actually cares about. So, markets today, following on the absolute massacre that occurred on Wednesday, we saw definitely not a strong performance from markets today. It was looking semi-decent for most of the session, and then a couple of downtick, couple of big red arrows to finish the session. So we had the NASDAQ down 93 basis points for the session, and the S&P 500 down 51 basis points. Big tech once again getting absolutely railed. We saw Microsoft down 2.5%, Google down another 3% after earnings, and Tesla actually did start to make a comeback, which helped out the WSO Alpha portfolio quite a bit, and is the reason why we absolutely smoked all the indexes today. It wasn't even close. Monster update for the WSO Alpha portfolio. In comparison, we were up a huge 1 basis point, yes, 0.01% for the session. But that brings us to a glorious 9.55% for the year because, god damn it, the last couple of days have been brutal. But nonetheless, Tesla's starting to make a comeback, and that really has been a big driver of our portfolio over the past couple of months since it ripped off of bottoms in late April. And now it's starting to pull back a little bit in the aftermath of earnings. But go check out our edition from a couple of days ago talking about Tesla's earnings, why it's not that bad, and why the market is really showing its paranoid schizophrenia in full force with the reaction to Tesla's earnings. So let us know what you think. Let us know if you're buying shares. Okay, moving on down. We got a lot of stuff to cover here today. So first and foremost, we're going to be talking about US GDP in just a quick minute because we just got the latest update for the numbers in Q2, and I think you're going to like what you hear, unless you're, 𝗟𝗓 𝗟𝗔𝗡𝗗𝗄 or something. You'll probably enjoy what you're going to hear from here on out. Then we're going to get into some of the big stock movers of the day. It turns out that war is absolutely phenomenal for shareholder value, and God, that makes me just fucking love capitalism even more than I already did. You're telling me I can profit off of dropping bombs on people? Let's go. Let's get into it. And then it does appear that teenage girls are experiencing an enormous and brutal recession. I don't know if it's a recession in their job market or daddy's money or what it could possibly be, but we'll break that down in just a quick minute as well. Then finally, we're going to finish it up with a classic American brand that just had its worst day ever since I was in 3rd grade, since the start of the Obama administration. We'll break down exactly why that happened. It's another absolute earnings hellhole. They say that earnings season is the most wonderful time of year, but it's a very dangerous game to play. Kind of much like Game of Thrones, when you play earnings season, you win or you die. That's basically it. And this company looks like they might be on the brink. But with that said, let's get into some of the banana bits. So first and foremost, the largest IPO of 2024 just happened. Markets are back. Once again, guys, mergers and acquisitions. Go get a job in investment banking. Sign up for WSO Academy because we will get you into that position. And you can work on the next biggest IPO of 2025 or whatever it might be. But for now, Lineage is holding the top spot as the largest IPO of 2024. And this is basically, it's like a REIT. It's super fucking boring, to be quite honest with you. But it was up 3% on the session, so let's go. Hats off to them. Next up, Southwest just reported earnings today. We had to talk about a bigger airline, so we didn't get a chance to cover Southwest in What's Ripe / What's Rotten today. But nonetheless, Southwest's latest earnings report is causing a huge change up at the company. They are no longer going to be doing open seating models. And having that activist involvement from Elliott started a couple of months ago probably played a role in this decision as well. But definitely go ahead and check out that story. Uber and Lyft also just breathed possibly the biggest sigh of relief in the history of capitalism when California ruled that drivers can remain contractors, so they don't have to be employees. They don't need benefits. You can fucking spit on them all you want to if you're the employer, I guess. But nonetheless, it's a huge sigh of relief for Uber and Lyft, who get to keep their employment costs relatively low. Finally, glucose monitoring system company Dexcom. This is a company that produces systems that people with diabetes and other conditions like that will be able to track their glucose in their blood. The stock is down almost 40% after hours, and I think we all know why. GLP-1 drugs are absolutely eating their lunch. So think Ozempic, think Wegovy, Mounjaro, all those other, obesity/diabetes drugs. It turns out that they do more than make slightly overweight people slightly less overweight. Okay. On that note, let's go ahead and get into our big story of the day. We are talking, of course, about GDP's nitro boost. The Olympics are starting today, but it seems like the United States has already won gold on these GDP numbers. So, in the United States, let me give you a recent news recap. We had our current president just dropped out of the election. Our former president just got shot. We're about to rack up an infinite amount of gold medals in Paris this year, and the economy just keeps fucking singing. And it's singing right along with Miley Cyrus because we can't stop and we won't stop. So let's go, well, for now at least. I mean, it's going to stop at some point, but I just hope that it's not for, well, actually, I probably should hope for like an economic collapse because then I can buy the market at lows. Nonetheless, either way, let's get into the breakdown for Q2. So real GDP in the second quarter grew a massive 2.8%. Say, David, 2.8%? I don't get out of bed for anything under 5%. Well, I see what you're saying right there, but you got to keep in mind that in the first quarter of this year, GDP grew by 1.4%. So we just doubled our growth rate in just a single quarter. Let's go to the charts and see what it looks like in the image. So obviously, you can't really see shit because this annoying ass bar in the COVID recovery is still here. But guys, only 1 quarter away until that bullshit is out of the way, and we can start to actually read this chart like human beings a little bit again. So nonetheless, this is what we're looking at right here, this little jump. I know it doesn't look like much, but that is a 100% increase in the quarterly growth rate for GDP. So let's break down exactly what's going on. Luckily, the Bureau of Economic Analysis is much better than the Department of Labor at covering actually intelligible graphs that mean something, and that's where we get things like this. So this is the real GDP percent change over here, kind of total in aggregate, and then we're breaking down some of the biggest movers and the factors that lead into the GDP equation in the blue bars throughout the rest of the graph here. So, like I said, real GDP up 2.8%. That was driven by consumer spending. So great job to everybody out there. Consumer spending contributed to about 1.6% of the total growth in GDP in Q2. So I'm just very glad that you guys are taking my advice, racking up tons of credit card debt that you're never going to get out of in order to contribute to the economy and keep this beautiful machine growing. That was followed up by inventory investment, contributing to about 0.8% of the total growth for the quarter. And that's followed by business investment, state and local government spending, more debt that we can all share together. And then it kind of trails off a little bit. And then we see housing investments and imports are the biggest detractors. Housing investments, that's a tough scene. Nobody's building houses. Somebody call my dad, order a house from his company so that we can actually start to turn this around a little bit. And meanwhile, inventories have been quite the detractor as well. But inventories being a detractor opens up an interesting question because from a consumer spending point of view, it's typically a good thing to see because it means we're still fucking buying shit. But if you look at it from a trade deficit point of view, it's not great, especially because large trade deficits for countries that aren't the United States tend to lead to a decline in their currency's value. When you're the global reserve currency, nobody really gives a fuck. I mean, it's like if we were, like during the gold rush in California, if we just held all the gold in the entire world, that's kind of like what it is being the United States and having the US dollar. Now, obviously, in the past couple of years, that has changed quite a bit, especially with Saudi Arabia being willing to take other currencies for their oil trades. But nonetheless, it's still something relatively positive to see. So, like we said, it was driven primarily by consumer spending. Inventory was the biggest detractor here. If I keep on going down, we already went over those vibe killers. But the real biggest thing in this report, and kind of the biggest driver, is a somewhat scarcely watched item. I don't know if it's something that we've talked about at the Daily Peel before, but it's what's called final sales to private domestic purchasers. So consider this everything that American companies sell to fellow Americans. They're good fellow Americans, whether that's citizens, whether that's other companies in the space. It's basically like, it basically strips out things like government spending, volatile measures like inventory investment. It's kind of like core GDP growth. I guess we could see it like that. And that grew at a very healthy rate last quarter at 2.6% at an annualized rate. So that was very good to see because that is basically a measure of underlying demand in the United States. So seeing that grow at a real basis of 2.6%, outperforming what our inflation target should be, but not causing an uptick in inflation at the same time is exactly where we want to be. It's that Goldilocks period. It's that soft landing in, well, continue it, not loading in, I guess, just in action now. We are currently living in the midst of the soft landing. And speaking of inflation at the same time, we did see that, we're going to get the real PCE report tomorrow, so let's hold our breath until then. But according to Gross Domestic Purchase Price Index, so this is basically what Americans paid for everything, inflation increased by about 2.3% on an annual basis. So keep that in mind. All the numbers that I said beforehand were real, so we don't have to do any adjustments or anything after that. But nonetheless, this is essentially what it looked like. Now, this also shows us the biggest cause for concern going into Q3. What we're seeing is declines in real disposable personal incomes, as well as, unadjusted. Nobody cares about unadjusted personal incomes, but real disposable personal incomes declined from the first quarter in 2024. So what this could potentially suggest is that maybe Q3 24 might not have as fast growth, especially in the consumer spending department, if our disposable personal incomes continue to grow at slower rates like they did in Q2. But nonetheless, it was all good vibes for the session here today. Didn't really do much to market rate expectations. They basically didn't move whatsoever, because the only thing that yesterday's GDP reading really says or makes me think is that I really, really hope that Fed Chair Mr. Jerome Powell, J-Pow himself, is off getting fucked up on pina coladas on a beach in the Caribbean somewhere, because baby, the Federal Reserve has all the time in the world to do whatever the hell they want. The economy's not breaking, inflation is continuing to slow, so they really don't have much to do. I mean, we're in that soft landing. We're in the Goldilocks zone. The job is done. They did it. And it doesn't really seem like anything's breaking going forward. Now, we will get an updated jobs report at the beginning of next month to give us the July jobs report. If unemployment is up from 4.1%, you can almost guarantee that the Federal Reserve is going to be cutting rates in September, but at least as of right now, it's still an open question, even though the odds are certainly in our favor. We're also including a new feature in the Daily Peel written edition, so go ahead and vote on this if you haven't done so already. That is the Peel poll. So we're going to be polling you guys every day, getting an idea of what kind of idiocy all of you apes are thinking about there. I'm so sorry. I don't mean to make fun of you guys. It's just my natural instinct. But nonetheless, the question that we're asking is, how much will US GDP grow throughout all of 2024? So you're basically predicting 2 additional quarters. Let me give you a range from less than 1% to more than 3%, breaking it down by 0.5 percentage in between. So definitely go ahead and vote, and we'll let you guys know the results of that poll first thing tomorrow. All right, we're already at 12 minutes, so we got to go a little bit quicker here. But what's right and what's wrong? Let's get into some of the stock movers of the day. First and foremost, we have RTX Corp, aka Raytheon Technologies, but they're called RTX after they merge with United Technologies. So this is the war company. This is who you're going to die for on the beaches of Taiwan if you're an American and you're under the age of like 25 right now. So just make sure you study their earnings report so you really know what you're dying for when you're laying there bleeding out on the beach halfway around the world. But nonetheless, what you're dying for is 1,038% free cash flow growth. So we're at least creating shareholder value. Nonetheless, the stock was up 8.2% for the session because free cash flow did really grow an enormous 1,038% year over year. Now, Raytheon was looking very good. Revenue may have only grown 8%, and earnings actually fell 92% based on some accounting things and some bad timing of certain other metrics that were included in the earnings report. But nonetheless, both beat expectations. The market already had this priced in, so the stock was up big time. This company literally cannot make missiles fast enough. They have almost $80 billion in total backlog, so I think they'll be doing all right for a while, and that's exactly why we say this is who you're going to be dying for. Uncle Sam and Raytheon Technologies. Moving on down below. American Airlines up 4.2% for the session. You know, I gotta say, I really am not surprised. It cannot be a coincidence that the airline with the most freedom, that created the most shareholder value on the day, they're really living up to that name, American. All they gotta do now is go and bomb a Middle Eastern country to try to steal all of their oil, and then they'll truly be living up to the name American. So they had a 3.8% earnings beat for the day. They were looking good for the quarter because basically the numbers were less bad than Delta and United. That's really what it comes down to. Yes, they were very much involved in a race to the bottom in total ticket fares. Net income was still down 46% for the year, but it was less bad, once again, than Delta and United. Keep in mind, apes, it's always all relative. It's never, good or bad. It's always better or worse. And because they did better than their competitive set, the stock is up for the session. Revenue grew 2% for the year as well. All right, moving on down into our rotten, stinky, poopy stocks of the day, we have, first and foremost, Lululemon Athletica. And this is why I'm saying that teenage girls across America are clearly in a horrific recession that we can't even begin to understand. The stock was down 9.1% on the session, and they didn't even have to report earnings to fall that much. They just got absolutely railed. They got triple teamed by JP Morgan, Citi, and TD Cowen. Coincidentally, very coincidentally, they all happen to downgrade shares and cut their price targets on the exact same day. It's almost like they collude about this stuff or something. Nonetheless, JP Morgan cut their price target by 26%. Citigroup down by 28%, and TD Cowen a measly little 6%. So basically, the driving force behind this, all three banks out of the exact same region, which, once again, coincidence much, but they basically said that a category slowdown in premium apparel is going to be driving underperformance for the next 12 months or so, is essentially what the take is. You can see this in the CPI and spending data, because what have we been talking about over the past month? Discretionary spending has been on the decline, and Lululemon is the definition of discretionary spending. Contrary to popular belief, it's actually not essential to get $95 leggings or whatever the fuck they sell. And I mean, the reason that we're saying teenage girls are in a recession here is because Lululemon is down. Starbucks was already brutalized after their latest news, and the stock fell quite a bit over the past couple of months there. The stock's down, I'm pretty sure it's down a good bit all throughout 2024. And I can't even imagine what's in store for Pinterest later this week, especially after the advertising data that we got from Google's earnings report. If Google is weak, then God help Pinterest, Snapchat, and all the other ones below them. All right, moving on down into our last stock mover of the day, we have New York Community Bank, who actually finished the day down only 3%. They opened in an absolute massacre, down more than 10%, but the stock traded up intraday. It was basically a dog shit earnings report. Literally, if Diary of a Wimpy Kid was a stock, it would be New York Community Bank, but it turns out that having overexposure to commercial real estate is even worse than having the cheese touch. That is essentially what we learned here on Thursday. Loan loss provisions were a big dragger. They dragged earnings quite a bit lower. So loan loss provisions spiked, like it sounds like a joke, but they spiked 695% year over year. And that was on top of a 330% quarterly increase in net charge-offs. That's driving up that loan loss provisions. Now, losses also came in at $1.05 per share. And that was about 133% wider than the 45-cent per share loss that was expected. Net interest income was 38% lower than the same quarter last year. Revenue missed by 9% on expectations on a 44% decline from last year. So once again, this bank, this is like the epitome of being overexposed to commercial real estate. And because nobody's going into the office, all that different kind of stuff. You all know what's going on with commercial real estate. I don't think we have to summarize that up right now. And because of that exposure, NYCB was down big time on the day, but once again, made a surprising recovery during the intraday period. All right, let's finish up. Let's try to keep this under 20 minutes with our Thought Banana earnings spotlight on none other than Ford Motor Company. God, this company needs Henry Ford to come back to life, because the stock was down 18.3% today, which hasn't happened since 2009, when the company was just getting off of flirting with bankruptcy during the GFC. Absolute dog shit earnings is a nice way to put it, because it really was disgusting. So first and foremost, the company missed earnings estimates by 30%, reporting net income of $1.8 billion, or aka about 47 cents per share, whereas estimates were for about 68 cents per share. So already we're off to a very ugly start. And then if we look at what was actually contributing to this, this chart does a pretty good job of summarizing all that stuff. So what we're looking at here is the year-over-year changes in revenue and EBIT of Ford's three operating or reporting segments. So Ford, it gets a little bit confusing because they make a lot of revenue from the financing side of the business, but we're only looking at the operational, well, financing is operational for Ford, but we're looking at the actual products that they sell. So Ford Blue, this is their legacy cars. This is the cars that you're buying from Ford, unless you're buying an electric vehicle, then that would be considered under Model E. So Ford thinks they're absolutely hilarious, going off the Model T that was coined by their founder Henry Ford back in the early 1900s, calling their electric vehicle unit the Model E unit. And then finally we have Pro. This is the segment of the business that sells all of those Ford Explorers to every police department in America and other basically business to business transactions, whereas the like trucking companies and shit are buying Fords. I don't know why they would buy an F-150 for anything, but nonetheless, that is what they did. And my first car was actually an F-150, so I refuse to speak ill on it. All right, so what do we see here? So Ford Blue saw a 7% increase in annual revenue, but a disgusting 49% decline in annual EBIT. Like I said, that was getting hit particularly hard because there was Similar to what we were talking about with New York Community Bank Corp, essentially what happened with Ford is they increased their own equivalent of loan loss provision. So with most automakers and a lot of other companies involved in the warranty space, they build up what's called warranty reserves. This is basically just a savings fund that they use when customers come in with problems that are still under warranty. So think repairs, replacements, other shit like that, parts that are under warranty. This is shit that Ford will pay for. So that increased by an enormous amount in the second quarter. They actually didn't disclose what the total amount of the warranty reserves balance was, but they did tell us that it increased by an enormous $800 million in the second quarter. And they also said basically now it's being estimated that it sits around 4%, which is more than double the historical average of about 1.9%. But again, we don't really know what's going on here. All we know is that the warranty reserves balance is increasing even faster than O.J. Simpson was driving in his Ford Bronco during that high-speed chase after, well, you know what, back in the 90s. We saw Model E revenue fall by about 5% for the year, but EBIT plunged, disgusting, putrid 37%. Very tough scene on the earnings before interest and taxes side for those of us who aren't fucking finance nerds. And then finally, Ford Pro was the only segment that looked like an actual business in the second quarter, with revenue up 9% and EBIT up 7% meanwhile. So very ugly period for Ford. They're getting slapped all over the place. CEO Jim Farley did try to put a positive spin on things, basically say like, this is the worst it's going to be. We're on the up and up from here. We'll see. We'll find out if that actually happens. From this point on, we're just asking if Ford can make a recovery, specifically in its EV business. And should Ford be in the race for autonomous driving? We know GM is. We know Tesla never fucking shuts the fuck up about it, but Ford hasn't said anything about it, so we don't know if they're in the space. We really don't know what is going on with them. I have not put in a quote yet, which I just realized, so don't be mad at me for that, but go ahead and check the edition tomorrow. Completely failed at keeping this under 20 minutes. You know what? I am going to do the quote from Henry Ford himself. That just seems very fitting, but nonetheless, almost 21 and a half minutes. I'm sorry you guys had to listen to me for this long. I'm going to go ahead and shut the fuck up. Thank you guys for joining us once again. It's 8:34 p.m. on this beautiful Thursday, and we will see you before we get into next week. So hope everybody has a phenomenal Friday, a great weekend. Happy investing, happy trading, and we'll see you then. Bye now.